Hello guys, my name's Colin and this is Colin Talks Crypto. In this video, we're going to talk about a couple things. First of which is why I just sold a piece of real estate in this market and my logic and reasoning behind doing so. Second of which, we're going to cover the US blockchain and a couple of pieces of huge news, such as Google Cloud has just become a block producer for the US blockchain. An executive from Goldman Sachs has just joined on Block One as an advisory member. And lastly, Bitfinex has released its EOS Finex decentralized EOS exchange. Thanks for joining me. Hey guys, I hope you can hear me okay. The microphone is far away. I am traveling. I did not bring my proper microphone setup, so this is just from my phone. I apologize in advance if the quality is poor or if the wind is distorting things. So the first thing I want to talk about is real estate and just some ideas I have on the subject. And I actually just sold a piece of real estate and why. So I've held on to a piece of real estate for the past couple of years. I only bought it like 2 years ago. And I did not intend to sell this real estate so soon. Come March of 2020, when the markets crashed and took a turn for the worst, I, like many of you, probably had a moment of panic. And for some, it was worse than others. And luckily, I didn't do anything too rash. I ended up buying some silver to diversify my portfolio, but it was like 1% of my portfolio, so nothing too drastic. And up until that point, I've been holding on to a piece of property. And I had no intentions of selling this piece of property. But after March, I sort of had to reevaluate my stance. And I love this piece of property. It's amazing, it's beautiful. I think that it's a great place. And yet, here I was struck with a decision of, should I keep this property in light of the current economic downturn and the changed economic situation? The US Federal Reserve has always been printing money and inflating dollars, so that's nothing new. But what I saw around March is a massive shift, more debt than ever before. I think I heard the figure that the US has printed 22% of its entire money supply in the past year alone. And for me, that's a risky proposition to be holding a debt in real estate. And not just holding debt in real estate, but the fact that historically, every time we've seen interest rates go close to negative or negative, and historically, every time the US Treasury yield curve has inverted, which I've covered in past videos, that has always preceded a recession or depression, in this case, I think. And what I've noticed when looking at those charts is that not only have we seen this pattern like 7 times or more before, where there's been an inverted yield curve preceding a recession, it's happened infallibly like 7 times in a row or more. I'll put the chart on the screen here so you can see what I'm talking about. But also the timing of things. And the big wake up for me was the timing on when the bottom of the ensuing depression or recession happens after that yield curve inverts. And when I looked at that chart, I came to the conclusion that it's roughly 2 years, give or take a year in either direction. So it could be 1 year, it could be 3 years. And so I feel like the moment that March crash occurred, the moment that the US Treasury's yield curve inverted, the timer started, the clock started for a 1 to 3 year timer on when we're going to bottom out on this economic crash and, I think, depression. So in light of the fact that I recognize it's about a 1 to 3 year delay between the Treasury yield curve inverting and that market crash and the actual bottom of the recession or depression, it really doesn't make sense to be holding such a large debt in the form of a mortgage when housing prices, in my estimation, are going to drop precipitously in the next couple of years, between 1 to 3 years. And so why have a debt that's going to go underwater, meaning that the value of the property is going to be worth less than the actual mortgage, the actual debt that I owe on it. And so I made the judgment call to sell this piece of property, and I have sold it. I have a buyer, and I'm proceeding. And so I'm going to cancel out this debt. I no longer am going to have a mortgage on this piece of property. And that money that I get back I can then invest in the future in property when it actually bottoms out. And so I feel this was a very smart move in light only of the changing economic circumstances. Had the March crash not occurred, I would not be selling this piece of property. And I just want to stress how much I really loved this piece of property. You know, it's beautiful, it's absolutely gorgeous. And so it was very difficult for me to emotionally detach myself from this investment. And I'm very proud that I was able to do so. And it was not an instant decision that I was able to make. I really had to think on it for a couple of weeks. And I finally snapped myself out of it. I'm like, you know, there's lots of beautiful property out there. There's lots of beautiful real estate out there. There's lots of amazing deals out there. And this is not the only one. So why should I hold on to a debt that's going to potentially go underwater? And not just potentially go underwater, but I estimate in my calculations, in my risk reward calculations, that it's more likely to go underwater than not in the coming years. And so I put it on the market. I have now sold it, and I'm very happy to announce that I have gotten rid of a liability. And so let's talk about liabilities now, liabilities and assets. And I've listened to people like Grant Cardone, who's our big real estate mogul, and some other guys about the subject of real estate. And I have to say, I've come to really agree with them. If you're going to buy a house, for example, that's really one of the stupidest things that you can do. I know that it's the American dream. I know that it's practically brainwashed into all of us at a young age that the dream is to own a house and a white picket fence and to go to school and get a college degree. And I'm just not one that tends to follow with the mainstream narrative, or I don't follow the herd. And I think that's part of the reason why I got into cryptocurrency. And that's part of the reason why I could see the advantages and the benefits and the innovation that cryptocurrency and Bitcoin are before the herd saw this. And I think that even today we are still early adopters in the cryptocurrency space. But as far as owning a piece of property, I think there's a right way to own a piece of property and a wrong way to own a piece of property. And when it comes to wealth generation in a person's lifetime, we only have so many years. And in my lifetime, if I'm to acquire liabilities early on, that exponentially deteriorates my ability to generate wealth later on. And these are not absolutes. Of course, anything is possible. But generally speaking, if I sink money as a sunk cost into an asset that does not return on my investment, that is a sunk cost and that is a liability. A house and a piece of property that does not return to me cash flow is a liability, because there are taxes, there are mortgage payments, and at the beginning of any mortgage, the vast predominance of the amount of money that you pay monthly does not go to the principal, it goes to the interest. So if you have, for example, a $3,000 monthly mortgage payment, $2,000 of that is going to go to interest. That means $2,000 of it, you're essentially just burning, you're lighting a match and burning those dollars, and poof, there they go. And only $1,000 of that is going to your actual principal. So you're throwing money down the drain when you buy a house or a piece of property. And of course, there's the argument that you could be renting somewhere and giving 100% of that money away to the actual owner, and you're getting no equity. But I think that if you have enough money to put the down payment on a piece of property like a home, the wrong place to put it is a home, because the home doesn't generate any income to you. You save very little in the way of monthly equity savings. And in fact, you waste an enormous amount of money. If you had 50 grand to put down on a house, you should put 50 grand into an investment that makes you a passive return on that investment. That's a far better investment and use of that money than a home. So I really have had a 180-degree shift of view on the subject of home ownership. And I used to ascribe to the American dream, you know, that owning a home is the greatest thing, the greatest goal you can have. And you pay off that mortgage in 20 or 30 years. And by the time you're 65, you've paid it off in full and you can live that American dream of retiring. And, you know, but who wants to retire when they're 65, when your best years are behind you? And you've spent your whole life, your whole working life paying off a mortgage and working so hard to paying off mostly interest, probably hundreds of thousands of dollars of interest in scenarios like I'm talking about. And so I think that a much smarter plan is to invest as early as you can in assets and vehicles that will return to you every month rather than take from you every month. And that is what I am now doing. And the ironic thing is that when 30 years is up and you could finally make that last payment on your mortgage, right? And you own your home, which, by the way, you don't really own your home because you always have to make tax payments in the United States. So if you don't pay your taxes, they'll take your home anyways. And if you don't make your mortgage payment, they'll take your home. So really, there's a pretty blurry line between mortgage payments and tax payments, because the outcome of not paying either of them is identical. You lose your property. So I actually think that it's a fallacy to say that one owns one's home in America, because one's forevermore a debt slave or a tax slave. You always owe something on that property forevermore. So if that property is not generating a passive income, returning money to your pockets every month, greater than the outgo, greater than the cost of maintenance, upkeep, and mortgage, then that is a liability. That is not an asset. And I will never again get caught buying a liability instead of an asset. So the right thing to do is to buy a duplex, to buy a apartment complex, to buy as many doors as you can afford, as many rooms as you can afford to rent out, and rent them out as early in your life as you can, and get that passive income generation occurring. And that is the approach that I'm going to be taking. And to kind of tie this back into crypto, I do have a vision for how I, in my life, am going to incorporate real estate into my crypto strategy. Because while I'm a crypto bull and I'm a perma crypto bull, and I think that this is one of the greatest investments that I can be making in my lifetime, even superior to property, at least in the current years, in these early adopter years, I do think that it's imperative to diversify because anything can happen. And I think that real estate is an integral part of diversification. I think that one should really have some basic staples in life. And those include cryptocurrency, and specifically Bitcoin, but other cryptocurrencies as well. I think that one should have property and real estate, because someone always needs a place to live, and you'll always be able to find someone to rent from you, if not you live in it yourself as a backup and a passive income generation source. And I think that having some precious metals in the worst case scenario, the apocalypse, the EMPs, the electricity goes out, etc., have a little percentage of stash of silver or gold on the side as well for those kind of situations, and other passive income generating sources. And those, I think, are some of the staples, as well as having, a gun, some ammo, and food and water. I think I've literally named every single thing that I deem as an important asset to be holding in one's life. It'll be guns, ammo, food, water, real estate, precious metals, and cryptocurrency. Those are my the top 5 assets that I think that a person must own in one's life to be totally secure, totally insured, not even with insurance companies. I'm talking about real insurance, actual ownership. Those are the top 5 right there. And so to tie this back into cryptocurrency, my kind of mid to long-term plan is to ride the coming bull run high. As I've been talking to you guys for 2 years now, I have not lost sight of the mountain, the bull run peak mountain, for one instant. This bull run peak is coming, guys. And at the top, no one knows where the top is going to be, and it would be a lie to tell you I know exactly where it's going to be. I've modeled where I estimate it to come, and so I'm going to be modeling my exit strategy according to my anticipation of the coming peak. And I will begin selling cryptocurrency as we approach that estimated peak in my mind. And you can do the same for yourself, wherever you think it's going to peak out. And at that point, I think that it's going to time beautifully, perhaps, with the crash of real estate. I think we're going to see a crash of real estate, potentially worse or as bad as in 2008. And so at that point, when we have crypto high, I'll either be buying real estate at that moment or setting aside the cash from my very overly valued cryptocurrency, irrationally high peak price at the bull run top, for stable coins and gold or whatever, securing that value, and then buying real estate at some later point when it finally does drop. I'm not going to be so impatient to pull the trigger on real estate just because cryptocurrency has gone to a peak in price. I will wait until the real estate itself is a dirt cheap deal. And if you watch one of my previous videos, I did talk about if you had a punch card and you could only punch it 20 times in one's life for making a trade, you'd really make that trade count. You'd really make sure that that was the best deal you could possibly make. And that's what I'm going to be waiting for, is that punch card deal for real estate. So whether it's timed with the bull run peak or whether it's a year or two later, I'll be waiting and I'll have the capital on the sidelines to be able to do that. And that's part of the strategy, is you have to have the capital there. You can't, see a deal and have no capital and take advantage of the deal. You have to be ready. And patience is one of I think the second best investment piece of advice I could have is have capital ready. Be ready to take advantage of that deal. Don't be all in on some asset class to the point where you can't afford to take advantage of an opportunity, an amazing opportunity, a 1 in 20 opportunity of the lifetime, and you can't take advantage of it because you squandered your money or you invested it in something that wasn't as good of an opportunity just because you were impatient. So that's my strategy. Anyways, guys, I think you get the idea. I think I'm gonna make a part 2 video here because this video is all about me selling my real estate, which I'm very happy I did, my anticipation of the coming market bottom, which I think could be a depression in the coming years from today, the bull run peak for cryptocurrency that is still on the horizon, coming in about a year, and my strategy, my coming exit strategy, which I will further detail with you guys as we approach that bull run high. I'm gonna make a second video here talking about the US blockchain and all those things I mentioned at the beginning, Goldman Sachs coming on board, Google coming on board with a block producer, and the Bitfinex EOS-based decentralized exchange. Please smash that like button if you like this, please share, please subscribe, and I'll see you in the next video. Thanks a bunch, guys.